Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence.
There were two important inflation numbers released yesterday, along with an important geopolitical development. There was the Indian inflation, which showed signs of moderation, and the US inflation, which remains elevated. This was in the backdrop of a conversation held between President Trump and President Putin with the agenda to stop the war. Now, oil did tumble on this development, and I say this also in the context that President Trump has been an advocate of lower oil prices. Good morning, JK. How are you reading yesterday's developments? Do you think this would ease inflation, especially on the energy front in the future?
Good morning, Swaraj. Yes, the geopolitical development is definitely looking very positive. In fact, that's also helping the euro currency to, recover and inflation going forward. In fact, if you look at the reaction from the market after the hotter than expected inflation, it's not been much. The stock markets in the US initially sold off and then recovered most of it, and the dollar also rose, strongly after the data. But except against yen, most of the other currencies are back to where they were trading ahead of the data. So I think market is definitely forward looking, and the geopolitical development, which can pave the way for lower oil prices, will definitely be good for the inflation going forward. And also don't ignore the fact that during the second day of testimony, Powell actually said don't give too much weightage to the CPI number, and he will be more focused on the core PCE number, indication about which will come after today's PPI number. So then market has calmed down quite a bit on this. Yes, before US CPI, we had the Indian CPI also. Again, that was a big relief for the policymakers because the inflation rate, fell quite a bit to 4.31% from 5.22%. And just remember that we had hit as high as 6.21% not long ago, and that's a good relief. And the RBI has already obviously taken an action on rates, cutting it 0.25%, and this development probably triggers discussion for another rate cut when they meet on April 9th next. So that's a good development for the growth aspect in India. And of course, this development was also due to a big fall in the food inflation, which has recorded now 6.02%. Which is the lowest since August 2024. In December itself, it was at 8.39%. Both rural and urban inflation have come off. On the industrial production side, there was a slight moderation to 3.2% from an expectation of 3.9%. Last month, it was at 5%. But this number is quite volatile, so not much of a weightage should be given as far as the policy is concerned. The US CPI, as we published yesterday also, the month-on-month number came quite high, recording as much as 0.5%. It was actually 0.446%. Year-on-year came at 3% compared to 2.9% that was expected. Definitely much higher. And what has happened? Two factors have actually played. As I mentioned yesterday, the firms tend to increase their prices in the beginning of the year. So the January effect is there. Secondly, the housing related inflation has not fallen as much as it was expected. Even Powell has been hinting at the fact that housing related inflation can come down, but so far it has not shown up. But there is a data that is published by Cleveland Fed, which shows that the latest house rental agreements are indicating quite a steady fall in the rentals. So maybe I think the market, which is forward looking, has ignored the hawkish data. And although the yields have remained high, and the expectation of rate cut in the year 2025 is just one, and for second rate cut, the probabilities are less than 25% as of now. So that's where it stands. Despite that, dollar has held on to the levels which traded near before the data itself. Yes, on the Russia-Ukraine front, there are positive indications both from the Russian side and the Ukrainian side. Of course, it's a deeply negotiating aspect that could take some time, but US side, they are actually sounding quite positive about that, and that's good news for the overall global economy and the the oil importing countries which are struggling with the higher oil prices. And Europe, for Europe, it will be quite a big relief as well. And for the rupee, yesterday we mentioned that 86.50 was going to be a very strong support zone where importers can get active. Of course, we did see an overshoot towards 86.40 as morning offers took it down. But since then, it has seen a steady buying, and we went up to 86.90 levels. Although now it appears that market is become slightly two-sided, and there are expressions of desire by exporters to hedge above 87.20, and that's quite reasonable because after seeing such a large move, if you look at it from the end of September, we have moved about 4.5%, and with the central bank showing its resistance to move towards 88, and also dollar somewhat plateauing off now, the gains in the dollar plateauing off, I think it is quite prudent to look at levels above 87 for some partial hedges by the the exporter community as well. Although I'm not calling for a reversal in the dollar's direction, but I think prudence demands that we can see both side hedging on the extremes of the dollar rupee. Looking ahead, we have jobless claims data and the PPI number from the US, which will definitely be some more pointers to how the policy will evolve going forward. We have a host of data coming from UK, including the GDP, unemployment, and the CPI numbers in the coming days, and that will be actually supportive of that we look forward to for UK pound. Yen has been interesting. It just had a strong 1 week after the the rate hike by Japan central bank, but it has halted ahead of 150 strong support zone. We've seen some weakness in coupled with rising US yields, and that's brought it up to 154 and a half. But it's really in a range, and any move towards 150, it will be definitely resisted by the Bank of Japan. So overall, dollar seems to be now awaiting fresh developments. We're still hearing about the aluminum and steel tariff, of course, will be effective from April. But anytime today or tomorrow, Trump might sign the reciprocal tariff on across all countries, which is also kind of expected. But I think when it comes, there can be some knee-jerk reaction of strength in the dollar. But overall, I think market awaits a bigger directional trigger for the dollar to actually move. Otherwise, we see some range trading continuing for this week. Thank you.
Thank you, JK. And just quickly summarizing, more range trading expected in the dollar. Dollar has, in the recent days, seen some plateauing, which is garnering some more interest emerging from exporters to hedge their exposures. But due to the rupee volatility, activity has increased both sides on the both extremes. The both importers and exporters are more keen to hedge, which is a good news for the banks, of course. But overall, in the global markets, we are seeing geopolitical developments looking positive. This development is, of course, positive for the inflation watchers. There is more work to be done, but positive indications from Russia and Ukraine side seems to be in place. More negotiations to take place to end the war. Indian inflation was lower, which is good relief and would trigger another discussion for further rate cuts in April. This was also attributed to large fall in food inflation. And when it comes to the US inflation, market has not reacted much to the hotter than expected US inflation. Month on month, it rose by 0.5%. Year on year, it rose by 3%. But A very important thing to remember, which JK also mentioned, is that there is seasonality as firms in the US increase prices at the start of the year, also called the January effect. That's it from us today. Thanks for listening. Tune in tomorrow for the latest round of updates from the financial markets.